We're taking a look at the economic week ahead right now with Elna Moolman. She's economist over at Renaissance Capital. Elna, thanks so much for joining us today. While most attention this week being paid to the Reserve Bank's MPC decision, many out there saying we've got the bank probably going to keep that repo rate at its current 3-decade lows at 5.5%. But it's the outlook moving forward that the market seems to be more interested in.
Absolutely. I don't think anybody expects any interest rate moves this week, but the markets will be very focused on what the Reserve Bank says in terms of both growth and inflation. What is quite interesting is if we look at what the money market has been doing over the last week, it got very excited about the possibility of a very early rate hiking cycle after the release of the quarterly bulletin last week. And then when we had the inflation data, it started pricing that out again. So I think at this point, the expectation in the market is probably for rate hikes from early next year. We think it could be a little bit later, so maybe towards the middle of next year. But I think this week's speech will be quite important in terms of some guidance in this regard. And I think particularly important will be the inflation forecast. So previously, the Reserve Bank had very high inflation forecasts for kind of first half of this year, then coming down to about 6% by the end of next year and slightly below 6% next year. But on the back of the inflation surprises in the latest data, combined with what's happening in terms of oil prices and food prices, it will be interesting to see how the Reserve Bank's inflation forecast would change. Ours were dropped a little bit in response to latest developments with regards to the food prices in particular, and that is despite high oil prices.
What about the comments that were made by the Reserve Bank governor herself? I mean, unusually hawkish comments coming through on that inflationary scenario, Elna, moving forward, where, we had market players being led to increasing their focus on rate hikes possibly coming through at the end of last year because of those, impacts coming through from a more generalized nature.
Yes, I think the statement in that speech that the market paid quite a bit of attention to was the fact that the governor talked about more generalized inflation. And she was probably there referring to the increase in core inflation. So if we look at CPI and we exclude all of the energy components and also food prices, then we end up with an inflation print that is about 4.3% right now. And of course, that compares to an overall CPI at more than 6%. So I think it's this increase in core inflation from about 3% to this 4.3% that she was referring to. I do think, however, it's important to keep in mind that this wouldn't have surprised the Reserve Bank. So for many months now, the SARB has been talking about this predicted increase in core inflation. It even gave us a forecast for next year saying that core inflation will continue to trend up. And it talked about a peak of about 5.2%. So none of this is surprising. And even with this in mind, it previously guided that it isn't in any hurry to start hiking rates and that it would like to keep rates on hold for as long as possible. So this didn't really change our views. I think the Reserve Bank governor really stated the facts and wasn't surprised this far.
We're also looking forward to PPI numbers come later this week. Elna, what are you forecasting on that front? Because we know that that's been lagging and producers have been finding it quite a struggle to pass on costs incurred at that level to the consumer at the end of the day.
Yes, so our forecast is for PPI inflation to moderate from about 8.9% in January to just more than 8% in February. Now, typically, there's quite a weak relationship between the current PPI basket and CPI. PPI is just dominated by commodities and mining, etc. So what will really be key in this number is what happens to food prices and specifically what is happening to meat prices. In last week's CPI, the big surprise was meat prices falling by nearly 2% on a month-on-month basis. And we expect this PPI number to show something similar, on the back of which I then think people may be starting to scale down their short-term CPI forecasts, primarily because of lower food inflation. So that will be absolutely key to watching this PPI number.
A key to watch, and of course all of these data points are very critical because it's within a credit scenario, Elna, that remains pretty worrying. I mean, we've had that debt to disposable income ratio dropping, but it's been so slight, and the credit levels of the average South African still seems to be quite a problem.
Yes, what is quite interesting, of course, is that if we look at the overall credit extension data, we expect about 7% year-on-year growth to be shown in the upcoming number. But if we look at just the household side, it is an interesting picture where your asset-backed lending, in other words, for houses and vehicles, is still very subdued, but unsecured lending growth is, of course, 20% plus. And we know now that the credit regulator will be looking into this unsecured lending growth, which has been this strong for quite some time. So in terms of the numbers going forward, what we would of course like to see is credit in terms of houses and cars starting to pick up further, but then hopefully some moderation in the unsecured lending. I just think the recent rates have been unsustainably strong, and if it continues, at some point we would start worrying about the risks that it entails, etc. So for now, not really a worry, but very important to see how these trends develop over the course of the coming year.